Hi folks, Nick Shaheen here, recapping the week ending Friday, the 3rd April. A market close day. However, we did get the NFP in the morning and more on that. So let's recap as of the results from yesterday, last day of trade. This is what the week looked like. We had some disappointment, but it did end on a good note. This is the S&P. The S&P logged in actually all indices were green. We had the Dow up 0.37%, about the same for the SPX. Lagging was the NASDAQ, 0.11% up. The small caps, 0.32% up. Sounds good. However, there was some scary, not scary, but a definite change in the behavior of the small caps on Friday. Up until now, they had been leading, meaning they weighted closest to the most recent highs, which were all-time highs. And they threatened to break out every day. However, the indices, the broader indices, did not join the party. So Friday, the small caps gave up and lagged until the end of the day, where the main indices ran on a spike in Apple, last-minute spike in Apple, came out of nowhere, to drag all the indices up for a nice close on Thursday. And the small caps did finally follow, but they lagged. So they did not lead up, and that was a change for me. That's my own personal opinion. Okay, so to make matters worse, I also thought yesterday, I started the write-up, and then I waited until this morning to actually publish it. I thought that we're going to, so far the rallies have been on relief. Something bad did not happen, for example, Greece, and things like that, that just, they're relief pops. They're usually shortable, except for the China news, which is also an interesting development this week. China basically came out and said, Draghi style, we will do everything we need to do in order to maintain our growth targets. What do they see that we don't yet? What's behind the wall? That scares me a little bit, that they're ready to do Draghi style threats. So let's see what comes out of China as far as growth. That's one note of caution for the bulls out there. And also, the thought is we're going to need some good bullish fundamentals on the back of which we can rally, instead of just rallying on pops or news headlines, relief pops that have nothing to do with fundamentals. So having said that, this morning we get the jobs report, right? And let me expand to show you what happened. Look at this drop. These were the futures this morning. We lost, what is that, 30 handles almost at one point, maybe 20 handles. The low was 20, 30 something. So a big drop. That's the S&P. And this is the NASDAQ, a big drop. And the scariest of them all is this one. These are small caps, and I'll tell you why it's the scariest of them all. You see this, first of all, this doesn't match the low, recent low. This is just within 7 days or so. So we've seen this before, not time to panic. We've seen it twice. Once, twice, just a couple of days ago, and here we are. We didn't even fall to it. So the green line is important, that it's holding in the S&P. That's important. The green line is holding in the NASDAQ minis, the NQ. Also important. However, one could argue that they may have touched it and breached it if you draw it at this line or this line. Okay, splitting hairs there. However, the change I told you, the small caps have changed their behavior, and look at the green line. These are the higher lows, still threatening to break out. I mean, these are all-time highs here, not too far away from. And finally, they just let go. Usually when they let go of a trend, they tend to overshoot. So I would not be surprised if we open week on Monday where people take bad news as bad news. Why is it bad news? We were expecting 240 new jobs. I think we got in to 127. Yes, folks, 127. However, we're still at a run rate for the 3 months that we have right now to beat every year in the past so many years except for last year. So it's not a disaster, it is a setback. Keep in mind, they had huge upwards revisions at the end of last year and the last report. So having been a numbers guy tells me something's up. Big swings like that wash each other out. Somebody made an error somewhere, in my opinion. But anyway, we also have to take into consideration the oil, the energy sector. What happened there? So much inflow coming into the year, And is it outflow and lack of inflow, the combination of both? So there is, one number cannot make a trend. We will wait this. I don't think this number will change Yellen's mind as to hike rates or not. Last Friday, she committed 3 points that not a lot of people talked about, I've mentioned. She committed to 2015 rate hike, even though she has to do it against a CPI that's under her target. She said that. And so will this change her mind? I don't think one data point will change her mind. Okay, so the hope that it's going to be 2016, the rate hike, I think, is still out. So therefore, bad news is bad news. It's not good news. We need good news to rally. So we'll see Monday morning. If they open green, that means bad news is good news, and there's still people hoping that there will be no rate hike this year. So that will be the debate for Monday morning. However, I'm going to be cautious. Why? Earnings are coming up. So how do I trade this information? The information is pointing that it's easier path downwards and up. So I want to pick on stocks that are wounded gazelles. I'll give you a case in point would be, for example, Netflix and Amazon. Why are they wounded gazelles? Because they're putting in lower highs, knocking on levels, underneath which we have big gaps, and that makes them liable to fill those gaps quickly. So put spreads in here may pay pretty nicely. Amazon is even better. Same, bouncing on 365. If it loses 365, mind you, it has lower highs, knocking on 365. Eventually, it's going to get tired. If the market's correct at all, this gets lost. It gets down to here quickly because of these fast candles, and then they'll be talking, oh, it's going to fill the gap and chance of getting down here. So put spreads in these two might not be a bad idea to protect a long portfolio that has a lot of longs in there. Okay, as far as the charts are concerned, let's look at the weekly charts here we'll go 1 year, and we'll look at the SPY. The week volume, obviously we had one less day, so it's hard to gauge. However, we've had 2 red weeks, lower highs, not a good deal, and we're kissing this line. We do not want to lose this rising wedge bottom end. If we do, markets might overshoot a little bit, and we revisit some lows here. Not a disaster. We have support here. So we'll see where it goes from there. Qs, the NASDAQ. I bet you will see the same picture. 2 red candles, droopy. Better in the trend. We have an ascending trend here rather than a rising wedge. Depends on how you draw it. But we have lower highs. And the range is shrinking, and now it's going to make a decision. Revisit the highs or the lows. You decide which way is better. I am more cautious. I'm tending to short the pops. The one that threatened the best, in fact, they had a green week, the small caps. This is their all-time high, and they had 2 weeks at the all-time highs. This one was pretty darn close, higher lows. So it has the makeup of revisiting the top. However, I think this Thursday behavior and this morning's behavior, maybe they want to put in a red week next week. So I'm watching this carefully to take cues, from which to take cues. So revisiting the variables at play, we've got political, danger looming everywhere, you know them, mainly the Middle East. The economy, the U.S., jobs report, yikes. China, yikes, what's behind the door. Rate hike coming, I think, in 2015, whether June or not, I don't care. Currencies, all over the map. The dollar got shellacked this morning based on the jobs report, but these are just reactions. I'll wait to see the trends. The QE in Europe, intact. There, good news would be bad news because it's data dependent, in my opinion. Oil, forget about it. Reacted so weirdly to the Iran deal. First of all, we're all confused about, do we have a deal, do we not have a deal, are the sanctions off or not? Oil did not react as if we have a deal. Oil did not react as if the sanctions are off, otherwise it would have plummeted. The ranges at play, they're still very iffy. I just showed you the weeklies. We can look at the dailies. These are the same charts on the daily perspective. That's the SPY bottom end of the trend, lower highs, higher lows, meeting point. There's going to be a move. Revisit the high end of that trend, this red line or this green line, or break down to the 200s. The SPX has potential to get down to the 2000, so this will be more likely down here for the SPY. It all depends on how we want to trade next week. And the pre-open note to members will have those details. Meeting point of break up or break down for the Qs, that's the NASDAQ, is right here. That's a doji-ish candle on Thursday, so energy is built up. It's going to jump up to here again or break down to here or closer to here. So I think there are moves coming. Direction still to be determined. I am more pessimistic than optimistic, but not to the point where I'm shorting everything right here. I'm giving myself room to be wrong. These are the small caps, nice ascending channel. This is a bullish candle. This is a bearish candle, so they wash each other out with regards to sentiment, so we're stuck here in my opinion. The next move is dependent on the whole market's breadth on Monday open. Those are the ranges at play. And some of the tickers I mentioned, there's one tickers that you guys and gals should pay attention to, and those are the transports. Best represented, easiest represented right here. The transports, I'll show you a 2-year trend. This is the chart to watch, folks. That's the 2-year trend. Nice, nice. Uh-oh. We went from ascending to leveling, right? So zooming back into 1 year. Leveling, and now we're ping-ponging this level, but look at that. Now both levels meet right here. The support the green, the support the red meet right here. Very bearish candle right there. Opened, tried to run, and then closed at the very low. Not good. And just below this one, this is not a scientifically drawn line, so it's a wishy-washy area, but lower high is knocking on a floor. How many times are the bulls going to be able to defend that floorboard? So is it a trap door down here? Or is it a bouncing board back up to the upper end of things? This is the question to be answered next week. Of course, we have plenty of other tickers we can discuss, but caution is warranted. If I have a portfolio made up of longs, I'd spend this week defending a little bit, buying some inverse downside ETFs if I don't have any. That's the easiest way of doing it. Buying calls in the VIX, I don't like it personally, but it works for a lot of people. So caution is warranted. Balance the portfolio. I've been saying it for 2 weeks because these are inflection points perhaps, up or down. No reason to get completely panicked, but there's definite lack of exuberance here. Nick signing out.